Welcome to Insights. I'm Eric. Thanks for coming by today. We're going to talk about the bond market. The bond market has been an interesting setup for quite some time. It's not something that's just popped up on the radar screen. Although we can see by today's trading and the trading that we've seen in the last couple of weeks that it's becoming more and more of a conversation that people don't want to have. The bond market is rallying and it's probably doing so unexpectedly. I can remember watching people say that the bond market would never take out its highs, it would never drop below the low yields we just saw, and it appears that the bond market is in the process of making those predictions look bad. I can't say that I feel bad for them because there's a lot of those predictions I've seen even in the commodity markets that will say we're never going to see such and such take out the high, and then it promptly does that against you can see is clearly opposing energy builds that are in place. So, but we're not going to talk about the commodity market. We're going to talk about the bond market today. The bond market is it's really looking to reorganize itself. We have the daily and the weekly time frames across the board in the bond sector, and I've isolated it here. They're both up, with the exception in that we have the Treasury market down on the primary trend. But if we continue to have strength, it's not going to take much time before the primary trend flips. And what's going to flip that? Well, it's going to be that energy build, and we're going to look at that more closely. We do have a primary trend flip that's taking place here in July in the high grade corporate sector. And this follows the junk bond, which has been up as well. And it's been up for 13 months and it's produced an 8% return. So clearly, there's a drive in towards the yield market that doesn't make complete sense towards the inflation argument. If inflation was going to be runaway and out of control, I seriously doubt that the bond market's primary trends in the private sector would be up, but they are up nonetheless right now. And again, a lot of that has to do with energy, even though these two don't report energy. But let's take a look at the energy markets or the energy builds inside the public sector, a sector which in terms of the name column is showing high compression, down arrows and columns, which means that we are quickly approaching a point of which we're going to accelerate or an acceleration phase from compression to expansion. And right now, the primary trends are down, but if that flips up after a calm like this, the bond bears could be really shaken up hard in the coming weeks and months. And we can see that and this is the or IEF or the 10-year, 7 to 10-year ETF. And we're really approaching the middle of the range that during the height of the lockdown and the aftermath of that was sworn by others that it would never be reached again or never touched. We're about halfway through to doing that. So it is something that I'm watching. I hope the rest of everyone watching this video is doing the same thing. It's a surprising feature. If the global economy is in deeper trouble than the world is going to admit, money is going to scramble back into the core for one last push, and that's going to send yields potentially down to zero or negative here, even in the U.S. Not sure negative interest rates will fly in the U.S. I think we can come really close to zero, though, or we can reach zero. Not because it has to happen, but it can happen because the bond market still in the U.S. is one of the few functioning bond markets in the world, while the other ones have been taken over entirely by their central banks, and so they're completely broken. So we're going to keep watching that, and the one thing that we can do is we can keep a track on energy. Here's the individual components, and down here is the bond market composite or the composite bond DI. Click this link up and you're going to see an energy build that's similar to this, an energy build that showed a huge bullish peak, of which it started a long time ago, and prices continue to drop. And within all peaks, and I've observed this in the past, these energy builds don't matter until they matter, and then when they do, everyone's gonna be shocked and surprised and turn around and say, how did that happen and why didn't someone tell us? Well, we were warned. I've communicated the invisible hand his intentions way back here. I said at the time it didn't matter. Now it clearly does matter. The energy build is unwinding. We're unwinding from this peak. We're unwinding downward. DI should drop all the way down here, and DI2 could easily drop all the way down below the lower threshold as well. We can move, and it's a long, drawn-out process. The process can take many years. It can take as many as two years to unwind this energy build. But the process of unwinding is generally bullish. Bullish to the upside. It moves things towards as this unwinds, the price tends to unwind or move higher. So there is really no stopping this, and it hasn't even really been a runaway rally yet, or primary trend hasn't flipped, but energy or WA, which is 62, is not even on the upper threshold as energy unwinds. So this is a slow and drawn out process, and it is this process that's causing quite a bit of havoc, not only in the bond market and treasury, in the currency markets, and as well as the now you can see in this morning, which people are starting to realize that it can affect the equity market. And I've said that these combinations could be closely tied with one another, but this was weeks ago when which we talked about this. The last thing that you may want to take a look at is the Pro Index, and I don't really have anything. Maybe I can pull up a Pro chart quickly here for us. It's something that the Pro charts you might want to see how the public is, what the public's doing relative to. And here we have for the IEF, here's the Pro chart, here's the Pro Index right here, here's the public index right down here. So as we curl back up to retest these highs or potentially break through them, we're seeing that the professionals are leading the way. They've been leading the way slowly ever since the low right here, whereas the public has bought the I'm going to be bearish on the bond market, even though I'm going to get the timing wrong and it could crush me. They bought that argument hook, line, and sinker. So we're going to watch the retail side sweat this one out. Eventually, they're going to come on board, and they're starting to do that as they follow up. But for a long time, they've been staying away from while the pros have been accumulating. What kind of dislocations is this all causing? Well, we're seeing the effect that it's causing a rally in the bond market. It's also having an effect where you can see the stock market is starting to turn down. And the weakness in the stock market shouldn't have been a surprise because there's the decoupling, the correlation disconnects here inside the matrix have been warning these have been all different states of decoupling. And that started sometime, I think about a week or two ago, and they're still even here as a warning that there's a disconnection or decoupling of price and what we would consider to be a risk. And when they decouple and they're no longer trending together, it's a warning that the stock market is vulnerable. So the stock market is still even vulnerable yet today, and yet I think people are going to be surprised it's going to be down. And the last thing that I would mention, there's a lot of things to mention. The Russell 2000 on the U.S. market cap leader is already pinned down low. That's concerning. It's in last place. It's concerning as the equity markets drop and the bond markets rally. The whole idea that the U.S. economy is booming and in terrific condition flies in the face of capital flows. This would be on top if the domestic economy was solid. So that's a concern for us as well. But I want to point down to lower, longer term, down lower in the matrix into longer term trends. These are the flows between corporate bonds and treasury bonds and the equity market. And the only thing that I can point out here is that everything favors or the different assets except for the bond market. It's favoring the long-term corporates right now because it's up. It's down. This one down because it's favoring the S&P 500. But the time cycles here are red. They're not bolded, but they're pretty close to 2 standard deviations, which means they're due for a flip. And they're due for a flip within matters of probably multiple weeks. It could be as much as a month or two. But there's a flip coming here where it's going to pull away from corporate bonds into treasury bonds, and it's going to pull away from the stock market into treasury bonds. And it's going to be the organization of that flow, which is going to be troublesome for probably what I would consider it's as the computer describes it right now, everything's risk on. But as these shift, it's going to shift to risk off, and I think that's where the trouble is going to begin. Risk off phases don't last a long time, but they can be the process of going from a risk on to a risk off phase can be painful, and then being in the risk off phase takes some time as well, at least last several months, and that can be painful too. So this is something I would keep an eye on, even if you don't trade any of the U.S. Sectors or stock market. The global economy follows the U.S. from risk on to risk off. So I'd use all this stuff. Right now, we have the vast majority of things are risk on, except for the risk off for the gold market. But this will start to change as the money flows and the capital flows internally start to move. And it is something that we're warning about, and it is something that this energy build within the bond market is a real possibility unless the bond market's going to rally during a risk on phase, which, again, anything is possible, but it's highly unlikely. So this is the setup for the bond market. It's a setup that you shouldn't have been surprised about. The bond market's building energy build has been on the table for months. I mean, it has been around since the first rounds of the reopening phase. So the market was talking to us a long time ago saying something's not right. But again, nobody wanted to listen to it at that point. But then now everyone's listening, but they're also late. So we'll keep an eye on this. So keep an eye on how the energy build unwinds over time. These are slow processes that take many months and can be as long as years to develop. So it is something that a dissipation of bullets energy build is inherently risk off. It's bullish for bonds, but it is something that I think we're going to talk about more, and the media is going to talk about more. We're going to stay ahead of them. We're going to have the conversations ahead of time before the media really talks about them. And I encourage you to watch these videos in the future and listen to them, because this is a very good example of how something doesn't matter until it matters, and now it's starting to matter. But again, that comment was made months ago, so we are finally looking at how that work is working out, and it could be a painful process for those who are not prepared. So if you have any questions, let me know. Contact me through the blog, or let me know under this video. This one's an open content, so if you want to subscribe to the channel that talks about all this and others, let us know. Like the button or hit a subscription. If not, we'll just keep plowing out these videos for the followers that are going to watch things happen before they get talked about in mainstream media. So thanks for watching, and enjoy the bumpy ride today.